Well, let's get more on a major event for markets this week. It is, of course, the Federal Reserve's meeting. They are expected to hike benchmark interest rates. Meanwhile, JP Morgan is saying that a key trigger for an inflection point in risk assets and market volatility will be when cash rates adjusted for inflation are at 1%. Based on current expectations, that's not going to happen until the third or fourth quarter of next year. So let's find out from Max Woolman, the senior investment manager at Aberdeen, whether he thinks that Goldilocks environment for risk assets is going to continue into the next year, into 2018. Max, thank you so much for joining us today.
Nice to see you, Tracy.
So that JP Morgan call, they say we have basically a stay of execution on some risky assets, at least until the end of next year. What do you think?
I'd agree with that. At the moment, while rates remain fairly benign, I think investors are still looking for yields. The likes of the emerging market debt universe is fairly attractive. You still get a decent spread over US Treasuries, so I still think we see inflows into the asset class going forward.
Right, but isn't the old market trope when it comes to riskier assets, when rates rise, if you see the dollar rise, and that must be bad for things like emerging market debt?
Well, I would counter that with saying that if rates are rising in the US, generally that means you're seeing stronger growth taking place in the developed world, which actually is beneficial for the emerging market universe, because they're able to export more commodities to the developed world, which you're still going to get growth in the EM world, which ultimately is beneficial for those kind of bond markets. What we like to see is growth, not too strong a growth though.
Right.
And that's our sort of perfect scenario for the EM world.
So does that mean the things that could knock the rally that we've seen, it has to be a recession in the US and maybe higher than expected inflation?
Yes, I think both those things are correct. So we saw a big recession in the US that had a huge impact in the emerging markets. However, we saw central banks react very positively. We've seen this quantitative easing and it's still going on. So actually, the central banks will react positively should we see that recession, which was not our base case. On the flip side to that, if we do see higher interest rates because of a big spike in inflation, that would be our biggest worry. However, we don't think you're going to see a massive growth spurge, and we're not really seeing inflation coming through yet. So at the moment, it's a kind of Goldilocks scenario for the EM world.